Hi, hello, welcome friends. In this video, I am going to discuss related to investment banking product wise some questions and behavior questions, etc. etc. And we will focus in next video that technical questions will be provided in next video. So first, I will go with the bank related specific hard technical questions different companies may ask. So maybe if you see the Goldman Sachs interview based interview, they will ask go for the this LBO process and present value cases. So what may ask, they will go through what is LBO, leveraged buyout model. So you need to specific leverage buyout model means. So you need to give in a high level. There are 5 steps in LBO. First, we need to calculate. Firstly, we need to calculate the total acquisition price, including the acquisition of the target equity and repayment of any outstanding debt and any transaction fees. You must calculate all the total acquisition price in the first case. Just a second. I will take in first. Yeah. What happened? LBO na first ELBO is the first question. So what we need to give, I think I will change the color. It is better to get answer. So in the LBO, you need to first answer will be calculator. What you need to calculate total acquisition price. In the acquisition price, it will include the acquisition of target equity and repayment any outstanding debt and transaction fees like you need to pay to the investment banker, deal lawyers, accountant, consultant, etc. etc. Now that all cost you need to include, and after that you need to determine what you need to determine how that total price will be paid. So it here include that equity from the PE sponsor or roll over the equity from the existing owners or managers or debt seller financing, etc. etc. After that you need to project the target operating performance over the 5 years. No, here he will know that project LBO project the target operating performance. So which is the your target company is there now, that target company performance will be provided for 5 years and determine how much the debt principal used to acquire the target can be paid using the targeted future cash flows over the time. So you need to project 5 years of projections what the target company's operating performance will be there, and project how much a target could be sold for after 5 years in light of this project operating performance. So here we need to get that cash inflows and cash inflow of next 5 years after the purchasing these cases, and how projected two projections will be there. Firstly, performance operating performance will be projected, and after that target can be sold. So how much if you want to sold, how much price we will get. After that you need to calculate the, I think just a second here. It will not go na. Okay. After that you need to get okay. Calculate the projected IRR. So red color. Okay. So calculate the projected IRR and MOE return on equity based on the amount of equity original used to acquire the target and projected equity returns upon exit. So what you need to give the high level when the LBO is the question. So you need to give the 5 steps. One, first you need to calculate the total acquisition price, and second determine how total price will be payable, and after that two projects. One is project related to targets operating performance over 5 years, and project target sold price after 5 years, and calculate the projected IRR. In this case, how when the project equity returns upon in exist, it will be Goldman Sachs LBO question. And after that next question it will be, just a second, I will remove this. So next question, now we are discussing about that company's present value. Now what might causes company's present value to increase or decrease? So present value increase or decrease, what are the causes or what are the factors the company's present value is increasing? So for increasing. For increasing, the reason will be firstly cash flows has causes on increase in future value. So cash flows was increase in future value, and after that increasing the growth rate of future cash flows. So growth rate was increased. This is the reason for present value will increase. And why the reason for decrease? Just a second, I think this one red for decreasing. For decreasing, I will take this one. For decreasing, increase the discount rate. So when discount rate is increased, the present value will go down, or delay in receiving the future cash flows. So you are not receiving the future cash flows, that's the reason present value will decrease the cases. And reduction in growth rate, this growth rate increases, present values will increase, and when the growth rate decreases, the present value cash flows will be decreases. This is the second question. So what we had discussed in the second question, present value, company's present value, factors for increasing, factors for decreasing. And another type, if you go for JP Morgan's company investment bank, they will focus on financial market, they will focus on markets. So they may ask, how do significant event impact the financial market? So you need to answer, what are the if they're in financial market, what are the significant impacts, how should a significant impact in event. So what are the significant events impact the financial market? If we take the live example, that COVID, so first will be financial, I think so, financial market impact. So impact, first answer may be COVID. If you see the in COVID-19, Delta variant is predicted to cause an upsurge in total worldwide cases. So therefore volatility will be increased. What happened in this case? Volatility will be increasing. Volatility will be increased in the stock market has a speculating investors who have debate the impact of variant. So this may cause run over the effect with the Federal Reserve System keeping interest rates low, moving towards forwards. What here happened when the volatility was increased, interest rates goes down. This first answer you may project in this, like, or if you go into more detail, that elections also one reason for impacting the market. So financial market impact, one will be the elections, one will be the because of that COVID-19. These are the answers you can provide. So significant. And how does interest rates affect the market? They will ask the market related in this care. So in the market, interest rate changes, how will it affect the market? For example, if you go into depth, when increase in interest rate, so what happen? Increase in interest rate, it will affect the cost of borrowing. So I think cost of borrowing means KD. So cost of borrowing impact will affect the when interest rate was increases. This means lesser amount of funding from the bank. So when the interest rate is high, cost of borrowing was high, the business persons will not try to get the amount from the bank, means they do not borrow from the bank. So then the lesser amount of funding from the bank will be there here, which lead to companies having slower growth rate. Then growth rate will be decreased. When a company does not have money, they cannot grow what it require. So why they do not have more money? In if you go for borrowing, they are asking more interest rates, so that they do not getting money from the banks, and they do not have more money, and they do not investing more, and so that growth will be decreased in the one cases. and higher cost of borrowing will also affect DCM, and I would expect that companies to issue fewer bonds or maintain the same capital structure but cut back the other expenses. For example, when higher borrowing cost of borrowing is affecting few companies may issue fewer bonds for to get the capital, and to get that capital they will issue the bonds now. When bonds issue, they need to pay the interest. Anyway they need money, so they will issue the bonds and they will pay the interest. For that paying the interest, they want to cut off some existing cost, so they may go for layoffs, that is removing some employees who are lazy persons is there in the companies, and this will also create the, and then the growth and lower valuation will be slower when the increase in cases will be happen. So on the other hand, higher cost of borrowing might also reduce the amount of leveraged M&A, that is mergers and acquisitions. So overall, when the interest rates was increasing, it will affect mergers and acquisition and capital market in a negative sense. So when the interest is increasing, this is the case will be there. I think there is one where, so interest, when the interest increasing, cost of borrowing will increase, growth will decrease, and this affect to mergers and acquisition. No one try to get the mergers and acquisition, and it will affect capital market in a negative sense. These cases will be asked in cases when if you go for this company, what the company, Morgan Stanley company, they will mainly focus on industrials and GDP growth. So if you go for, are there any special multiples that only apply to some industries or sectors? So they will ask the industry wide examples of industry sector multiples. They will ask here, industry means what will their retail industry or energy industry or technology industry, etc., etc. For specifying that industries specific multiples are there, they will ask. If we go further, industry specific multiples means if we go for a retail or airlines, for example retail or airlines, there will be EV divided by EBITDA. EBITDA means earnings before interest, tax, depreciation, amortization, where EV means enterprise value. Here where if you go for and here they will also have retail persons, they have rental expenses also. And if you go for energy, I think so, just a second, I will take the another color. If we go for this retail means I have taken airlines, after that energy. If you go for energy, here we will have EV divided by EBITDA. So here we have added R, here we will take the X. What is this X? There may be exploration expenses will be there for energy industries. If you go for airline, that is retail industries, they have rental expenses. And if you go for energy related companies, you will get that exploration expenses, that is daily production, EV divided by daily production, EV divided by proved reserve quantities, they will be there. And if you go for this where is that? After the industry, I will take that another industry, technology. If you go for tech companies, there will be EV divided by, and they will see that unique visitors, who are unique visitors, and they will page views, there will be there. So there will be simply, there are multiples will be there, specific multiples will be there, you need to answer in that type, and you need to, you want to give examples, you need to give in a retail or energy, it is the best example. And another question, that question will be, if company is working, and at the same time the earthquakes in the company was there, what would be happen for next year to the country's GDP growth compared to the year of the earthquakes? So when an earthquake cause the country's GDP to immediately, should GDP will sharply decline due to immediate effect of earthquakes, as there will be as lot of productive resources may be put out of use, so their resources will not used properly, and because of this earthquakes the GDP will decrease, and declining sharp immediately affect earthquakes, there will be lot of productive resources may be put out of use, and but then the GDP growth will start increasing to be above average level, as there would be increased amount of spending on rebuilding the instructions. Next, here in the when earthquakes was caused, the country GDP will immediately decline sharply due to immediate effect, and but then after that the GDP will grow, GDP will start to increase to an above average level, as there would be an increased amount of spending on rebuilding the infrastructure, so they will go for rebuilding their infrastructure in the cases. And after that city group interview companies, they will go in the equity based questions. So in the city group they will ask that, can a company have a negative book value? First question. So is possible company has negative book equity value? That's the question. So answer may be yes, a company would have negative book equity value if the owner are taking out large cash dividends. So when the company's owners are taking a large cash dividends, he is taking large cash dividends, then or if the company has been operating for a long time at a loss, so long termly it is operating a net loss for a long term, leading to the company having to take debt to fund loss of cash, eventually equity can become negative. So the answer will be there may be possibility for negative book equity value for the company. Mainly reasons for taking cash dividends or running the business in the net losses, this will happen normally. And normally what is the risk means? So here risk means, this is question in a broad mindset, means you want lot of room to work here. A common method of answering this question would be bringing up 2 to 3 different types financial risk concept, giving a straight definition as to what are they, and following up the examples will be provided. Here risk may be, there may be different types of risk will be there in the business and individuals. There may be like experience, and risks may be, firstly they may go for credit risk. What is there in this credit risk? This is the risk of a possible loss being incurred by a business or an individual should they borrow, fail to repay a loan, or meet contractual obligations. So here credit risk means it is one possible loss for by business or individual, and they borrow or they borrower fail to repay the loan or meet contractual obligation. They have some contractual obligation, they are not meet that obligation, or they are fail to repay that loan, then the treated has credit risk, and it is impossible to quantify the credit risk. So it is also not possible to quantify the credit risk and preciously predict which borrower will default on the loan, but there are risk management team will take care of that credit person. So whenever they giving money, and they will see the credit risk they which provided by this Moody or Credit Sai, this credit score they will observe, and they will build, this team will build minimize business risk and manage their credit exposure. And whereas another risk will be interest rate risk. As we discussed above, when the interest is increasing, then borrowing cost was increasing and growth will decrease. These are already I have explained in the cases. And another company, sorry, yeah, it will go. I think it will not come. Okay. So that BOA questions, so they will focus on terminal value. So how do you calculate terminal value? That is TV value. TV value here, TV means terminal value is the value of any investment at the end of the investment period. So TV means at the end of the investment period, what is the value? It is TV. This is usually assume that constant growth rate into the future. So here we will see the growth rate into the future, and it can be calculated by applying an exit multiple to the company last projected years EBITDA, EBIT are free cash flows or multiple methods. Here we can use the methods like garden growth method is there, and different methods also will be there to calculate this terminal value using this estimates TV based on its growth rate, its perpetuity. And where the formula for calculating a TV without accounting for growth, you can go for that formula will be expected free cash flows divided by 1 plus a required rate of return to time. With the formula you will get the TV without accounting for growth. When there is no growth, you can calculate like this. If you go for Gordon's method, they will go for DPS 1 divided by required rate minus GV. Different formulas will be there, different methods will be there. And what does investment banking dividends do? So here investment banking means if you go for the product provider, we have already discussed that mergers and acquisition they will do, leverage finance they will do, and equity capital market advice they will give, and debt capital market advice they will do, and improving the restructuring will be calling. And after that credit suisse company ask the questions like this: if REIT means this is related to real estate, that is REIT means REIT is trading below NAV, what is the strategic options they will ask. Means here REIT means real estate infrastructure related, and whereas M&A mergers and acquisitions seems to be off table because REIT has low cash flows balance. So when below NAV means it has low cash flows. So when the low cash flows balance, they cannot do stock issuance because they would be dilutive. Therefore my advice will be basically sell asset in non-core market to raise the cash. So here what happen in the REIT, it is trading below NAV. It is trading. What is your view? Means what is the option you give now? You need to give sell assets in non-core market and get the cash, and you can write the cash. That is the answer will be provided in that cases will be provided. After that this UBC will focus on, they will give some values and that questions, and I don't focus on that UBS. Okay, in next video we will focus on common interview questions.